Hi, welcome to my YouTube channel, Financial Experts. Today, in another exciting episode of Banking Concepts, we are here to discuss about an important ratio which measures the solvency and liquidity of the company, which is nothing but total outside liabilities to tangible net worth ratio, also called TOL by TNW ratio. This ratio is crucial for evaluating the company's health, especially its long-term solvency and financial risks. Now, before we deep dive into this particular concept, let me introduce myself. My name is CA Anjana. I am a chartered accountant, an author, speaker, ex-banker, and I'm passionate about teaching. I have more than 15 plus years of experience working in banks, financial institutions, audit firms, and listed companies. I have authored the book From Mud to Amber, which talks about the struggle of a female banker and the ways adopted by her to establish her own business. My teaching has helped various bankers in clarifying the banking concepts and also helped them in discharging their day to day works properly. In my last stint with a PSU bank, I was fortunate enough to head a region. I was a credit head of a particular region, and I have handled a book size of more than 3,000 plus crores. So, with this introduction, now let's deep dive into this concept. So, the importance of TOL by TNW ratio lies in the fact that it measures the solvency, long term solvency of the company. Now, this particular ratio is of great importance, especially to the bankers when a proposal comes for an enhancement or when you get a proposal of a particular client who's new to the bank. As the name suggests, this particular ratio has two components. One is total outside liabilities and the next one is tangible net worth. As I have already explained in the previous video of CME, total outside liability is nothing but sum of the current liability and term liability. And tangible net worth is nothing but it includes share capital and reserves. However, if it is a company, then you need to reduce the accumulated losses, the revaluation reserves, and intangible assets. Now, intangible assets, some examples of intangible assets are goodwill, patent, trademark, copyrights. If any of these are there in the balance sheet, the same needs to be excluded. Because here we are only bothered about the actual capital of the promoter in the business. That's why we are actually reducing the losses, revaluation reserves, and other intangible assets. Now, let's understand the importance of this ratio using three scenarios. Scenario one is where your total tangible net worth is 100 and outside liabilities, that is summation of your current liability and your term liability is 200. In that case, this ratio is computed as 2:1. Now, what is the inference of this 2:1? This means, suppose I have for every 100 rupees of the money in the business, 33 rupees is the net worth of the promoter and 67 rupees is the borrowings of the promoter from outside. Second case is where we have kept the net worth constant. However, we have increased the total outside liabilities. See, when we increase the total outside liabilities to 300, this ratio stands at 3:1, meaning that we have 25% equity or net worth in the business and 75% borrowings from outside. See, as we increase the liability in the business, the amount of equity reduces and amount of debt increases. In this case, when the TOL or total outside liabilities was 200 and net worth was 100, The debt component here was 67 and equity was 33. However, when the TOL has been increased from 200 to 300, you see automatically the outside borrowings have increased to 75 and equity has reduced from 33 to 25. So higher the outside liabilities, there will be an increase in borrowings because we are borrowing from the market. That's why. Now the third case where your total equity has been further reduced from 100 to 80 and total outside liabilities has increased from 300 to 360. In that case, this ratio works out to 4.5:1. This means that for every 100 rupees in the business, 18 rupees is the equity of the promoter or the tangible net worth of the promoter, and 82 rupees represents the total borrowings. Now, this particular ratio, when it reaches this level, this is the maximum level. Beyond this, a banker would not be interested in funding the proposal, especially when it is a new proposal or when there is an enhancement in limit. We have to restrict ourselves when the TOL by TNW reaches 4.5:1. This is the maximum level the ratio can. This is a maximum level at which this particular ratio is required to be in the business. Now, let's understand the definition. So, as I told you, what is TOL by TNW ratio? It measures the amount of total debt a company uses to finance its business compared to its tangible net worth. As we have seen in the three cases, that was what I was telling you. What is the percentage of net worth in the business and what is the percentage of debt in the business? So basically, this particular ratio will measure the total debts that a company uses to finance its business compared to its tangible net worth. Now, this ratio also indicates the leverage and risk profile of the customer. So, what do we conclude? The higher the ratio means company relies more on debt to finance its operations. Lower the ratio, confident are the bankers in funding the proposal. Higher the ratio, the bankers might not be interested in sanctioning additional funds. When I say higher the ratio, I meant 4.5:1. This is the maximum limit beyond which this ratio should not go. So, what are the benefits of an optimal TOL by TNW ratio? We would get easy access to the credit. So, if we maintain a healthy TOL by TNW ratio, you can enhance the company's credit worthiness, making it easier to secure loans and finance. There will be growth opportunities by leveraging debt. The company can access the capital for expansion, new project, acquisition, driving growth and profitability. Investors' confidence. Investors are likely to trust the company with healthy solvency ratio, which might lead to increase in confidence and investments. Now, what are the implications of a high TOL or by TNW ratio? See, high debt levels can lead to higher interest payment and increase in risk of default, especially during economic turndowns. Now, why do economic turndowns come? Because existence of a business depends on various other factors, market factors and other factors which might not be under the control of the promoters. So when the market trembles and when you have a higher debt levels, still you are required to make payment towards interest to the bankers. So, but your cash flows might not be that healthy. Hence, it is always advisable to keep this ratio at lower levels. A limited access to credit. Lenders may be reluctant to provide loans to companies with high debt burdens, limiting its access to future finance. And lastly, it will reduce the profitability. High interest payment can erode the profitability and potentially reduce the shareholders' returns. Now, what are the key takeaways from this video? We need to maintain a balanced TOL by TNW ratio because it is crucial for financial stability, overall solvency, and growth. You need to regularly analyze and manage the ratios to ensure a healthy financial foundation. One may seek professional financial advice to make informed decisions about this particular ratios. I hope you find this video interesting. Please do subscribe to my channel. You can also follow me on LinkedIn. And please to purchase my book From Mud to Amber, the link of which is given in the description box. Thank you. Have a good day.